Hello, and welcome to part 2 of our buy, hold, and sell blueprint. Today, we're embarking on a really critical journey into the mechanics of wealth creation. We are going to fundamentally alter how you view the acquisition of equity. Welcome, viewers, to Bodhi Unified Flow. Here we simplify complexity and amplify performance. I am absolutely thrilled to guide you through this explainer today, breaking down the exact fundamental valuation framework used by top-tier institutional capital allocators to decide precisely when to buy equity. Okay, let's dive into this. Here is our roadmap for today. We'll start with price versus intrinsic value, move into the DCF model, then look at price multiples, enterprise value, the unified buy matrix, and finally wrap up with a summary. So what exactly are you going to walk away with today? Well, by the end of this session, you'll master how to decouple intrinsic value from market prices, you'll know how to apply discounted cash flow fundamentals, benchmark relative valuation using price multiples, and, most importantly, execute your acquisitions using our unified buy matrix. All right, Section 1, Price versus Intrinsic Value. Let's talk about decoupling the market. Think about it, market price fluctuates wildly day to day, right? And that's because it's driven by short-term sentiment, temporary liquidity flows, and systemic behavioral biases. People panic, people get greedy. Intrinsic value, on the other hand, is rock steady. It's driven purely by projected cash flows and the actual underlying operational fundamentals of the business. You aren't just buying a ticker symbol, you're buying a piece of a real company. And this brilliantly illustrates the whole concept of the margin of safety. Basically, if you assess a business's intrinsic value at, let's say, 100, you don't buy it at 100. You wait patiently until the market misprices the asset. You buy when you're effectively getting $1 for 50 cents. Value investors exploit this exact structural mispricing to generate long-term compounding returns. Moving on to Section 2, Intrinsic Valuation using the DCF model. This is our absolute valuation engine. Now, you might be wondering, how do we actually calculate that intrinsic value? Well, practitioners rely heavily on the discounted cash flow, or DCF model. Simply put, this is a quantitative method that takes a company's projected future economic streams and mathematically converts them back into their present value equivalents. Usually, this means looking at the free cash flows available to the firm and discounting them using the weighted average cost of capital. So to make this work, it really boils down to 3 fundamental pillars: cash flow estimation, discount rate application, and the timing of those cash flows. Getting a grip on these 3 variables gives you the mathematical framework you need to determine if a stock is objectively cheap or if it's wildly expensive. Let's shift gears to Section 3, relative valuation using price multiples. I like to call these the financial superstars. Now, what's really interesting about this slide is the core economic rationale behind a price multiple. Sometimes absolute valuation is tricky, like if a company has negative cash flows right now, so we use a relative compass based on the law of one price. We relate the market price of the stock directly to a measure of its fundamental value per share, and then we compare that against benchmarks to see if it's relatively undervalued or overvalued. Let's break down these 3 superstars. First, the PE ratio, which is a massive focus for security analysts. It measures how much investors are willing to pay for just 1 unit of earnings. Next, the P/B ratio, which compares the market valuation against the company's net liquid assets. And finally, the PS ratio, which values top-line revenue. The great thing about PS is that revenue is significantly harder for a company to manipulate than bottom-line earnings. But here's a massive distinction you need to make when looking at PE. Trailing PE looks backwards. It uses the most recent 4 quarters of earnings per share. This relies on hard historical data, which totally avoids look-ahead bias. Forward PE, however, forecasts forward. It's calculated based on next year's expected earnings growth. You absolutely must know which one you're looking at to accurately assess the market pricing. Next up, Section 4, Enterprise Value and Ratios. Time for a holistic assessment. You know, moving beyond simple equity value is absolutely crucial. Enterprise value, or EV, measures a company's total value by adding market equity and total debt, and then subtracting the cash on hand. What this does is establish a firm liquidation value floor. It gives you a crystal clear picture of the outright acquisition costs, which ensures that critical margin of safety we talked about earlier. So, the crucial point here is understanding exactly when to use which metric. The PE ratio is fantastic for a quick assessment of equity value, especially when comparing companies that have similar debt profiles. But actually, EV to EBITDA is frequently superior.
Why? Because it fully accounts for both debt and cash, giving you a valuation that is completely independent of the company's capital structure. It's a game changer for debt-heavy industries.
Section 5. The Unified Buy Matrix. This is where theory meets tactical integration and execution. Let's move to the matrix and see how this all builds into a definitive, actionable buy signal. It starts with phase 1, quantitative screening. We rigorously filter for undervaluation using metrics like a low PE, manageable debt to equity, and strong return on invested capital. If the stock passes that test, it moves to phase 2, moat validation. Here, we need to verify that the business has a sustainable competitive advantage, a wide moat, and positive pricing power. Once we clear those hurdles, we hit phase 3, the forensic audit. We scrutinize those financial reports looking for crystal clear accounting and rock-solid corporate governance. And finally, when absolutely all of these analytical components align, we hit phase 4, the buy trigger. But we don't just dump our capital in all at once. We execute a scaled purchasing program, buying on a scale down to systematically neutralize timing risk. Just look at how this plays out. Waiting patiently for the asset to hit its multi-year low intrinsic value band, and then systematically acquiring it at a deep discount creates incredible compounding excess returns over the long haul. It takes discipline for sure, but the math is undeniable. Finally, Section 6, Summary and References. Let's lock in those key takeaways. To quickly wrap up everything we've covered today, first, always disconnect wild market sentiment from steady intrinsic value. Second, use the DCF model to estimate absolute cash flow value. Third, utilize EV multiples and PE ratios for your relative benchmarking. And lastly, always buy systematically through the multi-layered filters of our unified buy matrix. And just to note, the rigorous bottom-up framework we discussed today is derived from strict financial standards. We've drawn upon impartial insights from trusted sources like the CFA Institute, Zerota Varsity, and Ticker Tape, among others. These sources really reinforce the authority and the reliability of the Bodhi unified flow process. I want to leave you with a final provocative thought today. Ask yourself, are you simply trading a volatile ticker symbol, crossing your fingers and hoping for the best? Or are you systematically acquiring a fractional interest in a real operating enterprise with a mathematically proven margin of safety? The difference between those two approaches is literally the difference between hoping for wealth and actually engineering it. Invest wisely, everyone.